Hey, happy Monday, everybody. Your man Omid here with you once again to try to make sense of this crazy market that we're in. So stay with me and let's see what's going on, okay? All right. The market. This is this morning's mortgage-backed securities. As we had talked about a couple weeks ago, unfortunately, my predictions came true with what it is that I saw from inflationary numbers, and the market has continued to decline. Remember, when there's less money in the market, rates get worse because there's less money to lend. So stay with me in 2 seconds, and we'll go into a detailed explanation of what's happening. Last week's rates were at 7%, high sixes, low sevens across the board. Today, they are aggregator buddies over at Mortgage News Daily, dyslexia, are showing a 30-year fix at 7.44 and a jumbo at 7.6. Now, again, take all that with a grain of salt. They're aggregators. They're gathering all the information on the web and publishing the averages here, but that's the national average. But more than anything else, it's certainly a negative sentiment, and rates are going up. There's no two ways about it. Now, there's fixes around all this, but stay with me. The culprits. Why is that happening? Well, retail sales came out, and the number rose from 0.3 to 0.7. That's pretty significant. Additionally, it showed that there's a February revision as well from 0.6 to 0.9. That's also significant. Now, what is retail sales? We are spending way too much money. That's all that there is to it. Whether it's people spending it on credit card and going and driving themselves further into debt, or people that have money sitting in their stock account, in their restricted stock units, awards program from their work, whatever that is, folks are seeing their money rally as a result of the stock market going higher and higher and setting new records every third week. By the way, based on the hope that the Federal Reserve will reduce the Fed funds rate, that's what all that is happening. And now, because of the inflation numbers, because of how much money we're spending, that hope is going further and further and further out. As a matter of fact, now there's less than a half of 1% chance that they will change anything in their July meeting. I'm going to stand strong on my own prediction and say we're going to see one rate decline that's going to be closer to election. That's what I think. This week, housing starts are going to come out. So those are the permits. Wednesday, mortgage application and bond auction to see what kind of appetite bond traders have. Initial jobless reports, people claiming unemployment for the very first time, and existing home sales. So lots of heavy housing reports coming. Now, quick little pause here. The one thing that's going to be omnipresent here for the next little while is going to be this Iran-Israel conflict that we're now seeing, and hoping to God that everything stops peacefully and nothing else escalates. Not just for the lives that'll be taken, but really also because of the fact that any kind of action like that in the Middle East is going to show up as an inflationary. It's going to show up at the pump. So it's going to drive our inflation numbers up, drive global inflation numbers up. So there's nothing good that's going to come out of this. Okay. Now, before we go on to the meat and potatoes of today, I have a quick favor to ask you. If you find these reports valuable, if you get something out of them, I have a quick favor to ask of you. I want you to like this so I can propagate and send it out further. If you've noticed, we're now on YouTube, so it's a different environment as far as where we store these videos. And like the video and send it out to somebody who you think is going to gain value from it, because I'm trying my best to bring value to you and hopefully grow this account and get more people to understand at a deeper level how these things work. The smarter that we are, the happier that we are. Yeah? Okay. Speaking about being smart, something's happening that we're all seeing in the real estate community, right? Multiple offers are back. We're seeing them everywhere. And one of the things that's going to happen because of the multiple offers is we're going to probably start seeing some appraisal shortages. We've seen one already, and that's the case study that I built for you here today. You see, there's a time where multiple offers come in, and they kind of go up. Before those are recorded with the county, there's usually a 20 to 30-day period. The appraisers, as they go out there and they try to appraise these properties, they can only use recorded sales, right? And so as they're looking for that, there will be a lull of that 30, 45 days that they need to catch up on. And sometimes, like this case, sometimes this thing got bid up to $750,000. That was what was on the contract. After the appraiser did the appraisal, it came in at $710,000. That was a $40,000 appraisal gap here, right? Now, we went through the reconsideration of value process where we gather additional documentation, et cetera, but all the findings showed that the appraiser was right and there just wasn't enough comps to support this thing being $750,000. Okay, you with me? So this buyer specifically was very, very, very payment sensitive, right? And he had saved up for God knows how long, didn't want to pay mortgage insurance, was very sensitive to that. So here's the solution that I came up with, right? By adding a single premium mortgage insurance payment up front, which happened to only be $4,200. Remember, his appraisal shortage was $40,000, so that was a choice. He was going to have to come in with $40,000 more dollars, right? Because remember, banks across the board, mortgage companies across the board, they will lend on the appraised value or the purchase price, whichever one's lower. So 710 is what we're going to lend on, what any bank is going to lend on, right? And so by being able to add this 4260 and pay his mortgage insurance premium up front, we keep his payment exactly the same, keep his rate and APR exactly the same. His cash to close obviously goes up by that $4,000 that we're adding, but guess what? He gets to still buy that house because he loved that house. His wife loved that house. They wanted the house, but it came in short. Instead of come in with $40,000 more dollars to shore up the deal, a $4,200 upfront mortgage insurance premium enabled us to be able to get him in there at the same rate, at the same fee, et cetera, et cetera. Okay, cool. So use this information. This is where he was buying, by the way. I think it's an important module to discuss with you that we have access to. I'm happy to do this for any of you, but we were able to show him that, even though he paid $40,000 too much for the house, if that's one way of thinking about it, he was going to break even in 12.6 months, right? So in just over a year, he was going to make up that $40,000 because of the way that this property has a projected value over the next 5 years based on the historic projections for that specific zip code, right? So if you run across these things, make sure your loan officer has a good understanding of this process. If they don't, give us a buzz. I'm happy to help. And let's go out there and let's educate people and let's help them. And I truly appreciate you guys liking this video and forwarding it on to somebody else who you feel like needs to see it. This is the way we're going to hopefully be able to grow the channel and help everybody in our community to get better than what they do. Okay? Awesome. Well, have a great week. And as always, I'm posting on our Instagram account updates that happen during the week. So if you don't have that already subscribed to, there's a link in the email. You can just click right there and subscribe to that so you don't miss anything. Okay? Cheers and have a great week. Bye-bye.